everyone. So for this week we will be learning about flexible budget. So flexible budget is a bit different from the budget that you have learned in the previous chapter. But you will see some similarity later on, but we will explore the difference as we go through to this chapter. Okay, so planning budget are prepared for a single plan level of activity. So this is what you have prepared in the previous chapter, whereby we have a targeted sale, targeted production, how many raw materials that should be purchased, and so on. Okay, so those budget are set at a fixed number that we have targeted. Okay, so let's say we wanted to make 500 cells. Okay, so how many production is needed in order for us to achieve that 500 cells later on? So this is what we call as a single plan level of activity. Okay, so this is the one that we have learned in the previous chapter. So performance evaluation can be difficult when actual activity differs from the plan level of activity. Okay, so the planning budget is only our target. Okay, only an estimation or prediction or goals that we wanted to achieve. However, the actual activity or the actual revenue and actual cost might highly likely will be different with what we have planned previously. Therefore, by comparing the static planning budget, static here means a single plan level, with the actual cost that we have incurred, therefore it's like comparing an apple and orange. Okay, so means that we are comparing two different things, which is unfair and can make the process difficult. Okay, so flexible budget, this is where the flexible budget comes in. It can be prepared for any activity level in the relevant range. Okay, so it means the budget can be flexed later on with a different level of activity. Okay, so you will prepare a budget. It can be altered for 300 cells, or it can be altered for 400 cells, or it can be altered at 600 cells. Okay, so it shows costs that should have been incurred at the actual level of activity, enabling apples to apple cost comparison. Okay, enabling a comparison of a similar items of a similar items. It can help managers to control costs and improve performance evaluation. So in this chapter, we will use Larry's lawn service as our example. Okay, so Larry's lawn service provides lawn care in a planned community where all lawns are approximately the same size. At the end of May, Larry prepared his June budget based on mowing 500 lawns. Since all of the lawns are similar in size, Larry felt that the number of lawns mowed in a month should be the best way to measure overall activity for his business. So this is Larry's planning budget, the static planning budget. Okay, so here it is based on the number of activity of 500 lawns. Therefore, the revenue, the planning budget, the cost formula is $75 per lawn. Okay, so the revenue for 500 lawn would be $37,500. And for the expenses here, wages and salaries, 5,000 is a fixed cost for wages and salaries, plus another $30 per lawn. Okay, so the total would be 5,000 plus $30 times 500 lawns equals to $20,000. So same goes to gasoline and supplies. Larry will incur $9 for gasoline and supplies per lawn. Therefore, for 500 lawns, it will be 4,500. Equipment and maintenance, $3 per lawn. And office and shop utilities, office and shop rent, equipment depreciation, and insurance is a fixed cost. Okay, if there is no quantity in the cost formula, therefore it can be considered as a fixed cost. So for wages and salary, It is a mixed cost of fixed cost plus variable cost, but for gasoline and equipment maintenance, it is truly a variable cost. Okay, so the total expense is 32,500, and Larry is expecting 5,000 net operating income if he managed to get he managed to launch 500 lots. Okay, so this is Larry's actual result. So in the end, in June 30th, Larry managed to exceed the number of lawns that he has targeted before. So he has targeted 500 lawns. However, at the end of the month, he managed to launch 550 lawns, which is 50 lawns extra from what he targets. Okay, so the revenue that he has obtained is 43,000, and the total expenses was 36,550. Okay, so the wages and salaries, the office and shop utilities is 950 instead of 1,000. Okay, and office and equipment depreciation remain the same, and insurance incurred increased by $200. Okay, so if you want to compare between the planning budget with the actual result just now, so this is the comparison. Okay, so in this chapter you will be calculating variances. Okay, all right. Okay, so the number of lawns here is 500, but the actual result is 550. So as you can see here, the planning budget is represented by the apple icon here, and the actual result is represented with the orange icon here. Okay, so if you want to compare it, you can see that Larry is obtaining a higher revenue. So therefore, the variance or the difference between the planning budget and the actual result for revenue is $5,500. Okay, so we level F here. So F um, is for favorable. Okay, so for revenue, we get favorable variance when the actual result exceeds planning budget. Okay, so for revenue, we get favorable variance when the actual result exceeds planning budget. All right, so the expenses here, as you can see, the higher the number of the lawns, therefore the wages and salaries will also be higher. Therefore, we will have a variance of 3,500 U. U is for unfavorable. Okay, so for expenses, we get unfavorable variance when the actual result exceeds planning budget. Okay, so it's totally contradicting with the revenue just now. Okay, so for revenue, we get favorable variance when the actual result exceeds planning budget, and we get unfavorable variance when actual result does not exceed planning budget. However, it contradicts with the expenses. We get unfavorable variance when actual result exceeds planning budget, and we get favorable variance for expenses when planning budget when actual result does not exceed planning budget, means that the planning budget is bigger than the actual result. Okay, so please understand that concept. Okay, as you can see here, um, you have to calculate variance for each of the items, and then the total expenses is 4,050 variance, which is unfavorable. Okay, so the net operating income is the difference would be $1,450, and it is a favorable. Okay, because the actual net operating income is bigger than the planning net operating income. Okay, so this is what I have explained before. So since these variances are unfavorable, has Larry done a poor job controlling the cost? Or since these variances are favorable, has Larry done a good job controlling these costs? So it's quite hard for us to answer these two questions because we are comparing apple to oranges. Okay, we are comparing something that is not the same. This is for 500 lawns and this is for 550 lawns. Okay, so we cannot compare these two budgets. Okay, so so the relevant question here is how much of the cost variances is due to higher activity and how much is due to cost control. Okay, so we would like to know which one that Larry has managed to control the cost, or which one is because of the cost, higher cost was incurred because of the higher activity that Larry has incurred as well. So to answer this question, we must flex the budget to the actual level of the activity. So to flex the budget, we need to know that total variable cost changes in direct proportion to changes in activity. Okay, so the higher the activity here, therefore the higher the variable cost will be as well. And then the total fixed cost will remain fixed, will remain unchanged within the relevant range. Okay, so this will be the total activity. Okay, no matter how high the total activity will be, the cost will be fixed at the relevant range. However, when the activity changes, increases, therefore the variable cost also increases here. Okay, so let's prepare a flexible budget for Larry. Okay, so this is Larry's flexible budget. Okay, so this is the cost formula that we have seen in the previous slide just now. So we will change the quantity to 550. Okay, so the revenue of 550 lawns is 41,250. Okay, and same goes to wages and salary. $30 times 550 number of lawns plus 5,000, then you will get 21,500. Okay, so you total this up and you get total expenses of 34,600, and that gives Larry a net operating income of 6,650. Okay, so what should be the total wages and salaries cost be in a flexible budget for 600 lots? Okay, so as we have known just now, the cost formula to calculate wages and salary is 5,000 plus $30 times the quantity of the number of lots. Sorry, the quantity of the lots. Okay, so we can actually plug in into the cost formula just now. So the 5,000 plus $30 per lawn, which is 600 lawns, then you will get 18,000 plus 5,000, and the total wages and salary will cost for $23,000. Okay, so next we will prepare a report showing the activity variance. So what is activity variance? Activity variance is the difference between the budget amounts between planning budget revenue and expenses and flexible budget revenue and expenses. Okay, so this is the apple just now and this is the orange just now. The difference between these two is what we considered as activity variance, because planning is based on 500 lots just now and flexible is 550 lots. So this is, when we compare these two, it gives us the activity variances. Okay, so this is the planning budget just now and this is the flexible budget. Okay, so these are the activity variance. Okay, the first slide that we have seen just now. You just have to minus every single thing. Flexible budget minus planning budget. And then please understand the concept of revenue and expenses. Okay, again, I repeat, we get favorable activity variance for revenue when flexible budget is bigger than planning budget. But for expenses, it contradicts, it is opposite of that. Okay, if the flexible budget is bigger than the planning budget, therefore under expenses it is considered unfavorable, unfavorable variance. Okay, so here we minus it out, so this one no changes, therefore no variance here. So we get a total of net operating income favorable of 1650. Okay, so the activity and revenue increased by 10%. Okay, 10% of 500 is 50, therefore the activity increases 10%, which become 550. But net operating income increases by more than 10% due to the presence of fixed costs. Okay, so it increases by 33% and not by 10% because of the fixed cost just now. As you can see, there is no variance for fixed cost, but there is a variance for variable cost. That is the cost of that is making the increase of net operating income bigger. So prepare a report. Next is to prepare a report of revenue and spending variance. So what are revenue and spending variances? The difference between the flexible budget revenue and the actual revenue is revenue variance, and the difference between the flexible budget costs or the expenses and and actual costs or expenses are called as spending variance. Okay, so let's use the flexible budget just now. Okay, so here flexible budget based on 550 loan is labeled with, represented with the apple icon, and the actual result just now was already the apple icon. So we are comparing apple to apple right now. Okay, it's fair to compare these two because the flexible budget is based on 550 activity level, and same goes to the actual result. Okay, so revenue here for flexible budget, by using flexible budget, the revenue is expected when Larry is mowing 550 lawns is 41,250, but the actual result that Larry got by mowing 550 lawns was 43,000. Therefore, there is a variance of revenue variance of 1,750, which is favorable because the actual result is bigger than the flexible budget. For expenses, wages and salaries expected to be incurred for mowing 550 lawns is 21,500. However, Larry has incurred 23,500 in mowing 550. This is the actual one. Okay, so there is an unfavorable spending variance of 2,000 because the actual result is bigger than the flexible budget under wages and salaries expense. Okay, so it means that Larry is expecting 21,000 only, but he has incurred 23,000 actually. Okay, so under office and shop utilities here, um, it was supposed to be a fixed cost, therefore it shouldn't be um, changing. Okay, the variable costs, the expenses which has a variable cost component is expected to change according to the number of lots. Okay, when the activity changes level, when the activity level changes. However, for office and shop utilities, office and shop rent, equipment depreciation and insurance consists of a fixed cost. Therefore, we shouldn't be seeing changes in the actual result actually. However, it seems like there is a difference between the utilities and insurance expense. So there must be an explanation why this fixed cost suddenly increases or decreases. Okay, because it shouldn't be changed according to the activity level. Okay, so it seems like perhaps one of the explanation that we could give with that Larry could give would be that the utilities might perhaps there was a decrease in the utilities rate. Okay, perhaps subsidy by the government or decrease of rates, or maybe um, If it's in the western country where they have 4 seasons, perhaps this the decrease was happening in summer, whereby utilities is not used as much as during in winter seasons. Okay, and then for insurance, perhaps there could be a increase of insurance premium. All right. Okay, so the total expenses is unfavorable, and net operating income is um, Larry is expecting to get 6,650 in when mowing 550 lawns, but the actual net operating income that he has obtained was 6,450, which is 200 um, variance, unfavorable variance, because um, the profit is bigger in the flexible budget as compared to the actual result. So this is revenue variance, and this one is spending variance. So prepare a performance report that combines activity variance and revenue and spending variances. Okay, so this is the performance report that we can combine all these three variances. So what you have to do is, the first column would be the planning budget, okay, and then the flexible budget, it will go in between, and then last one is the actual result. So the difference between planning budget and the flexible budget is activity variance, and the difference between the flexible budget and the actual result will give us revenue and spending variances. So as you can see here, activity variance can be also calculated um, by calculating the extra activity. Okay, you can take 50 more lawns, the 50 extra lawns here, times with the cost formula. So 75 dollar times 50, then you will get 3,750. Okay, you can actually use the cost formula to calculate straight away the activity variance by taking into consideration the extra lawns, the extra activity into the cost formula. Okay, however, for revenue and spending budget, and spending variances, you need to draw up flexible budget first. Okay, you cannot use the extra loans, because these two activity are the same. Okay, so you need to draw up the whole flexible budget first, then you compare it with the actual result. Okay, then sometimes there are flexible budget with more than one cost driver. So the cost formula can be also adjusted to recognize multiple cost driver. Okay, so let me explain a bit. Okay, so in this cost formula, it is only taking into consideration the number of lots. Okay, so that it means that there is only one cost driver, which is the number of lots. Okay, however, for multiple cost drivers, okay, because of the large unfavorable wages and salary spending variance, Larry decided to add an additional cost driver for wages and salaries. The variance is due primarily to the number of hours required for the additional edging and trimming the lawns. So Larry estimates the additional hours and builds those hours into both his revenue and expense budget formula. So it means here that Larry wants to take into consideration to put the number of hours as well in the cost of wages and salary to reduce the unfavorable spending variance that he has gotten in the wages and salary previously. Okay, so here this is the first cost driver, and the second one is the number of hours that the employees has to spend in order for them to mow, to edge, trim the lawn just now. Okay, so instead of having just one cost driver, which is the number of lawn just now, therefore Larry has added another cost driver, which is the hours spent to trim and mow the lawns just now. Okay, so under this cost formula, the revenue will be increased because they have taken another consideration of the cost driver just now, so that this revenue of ours can be paid, can be used to pay the wages and salary. Okay, so the wages and salaries right now has a fixed cost here, and then has one cost driver, which is the number of lawn, as well as an additional of $25 per hour spent in mowing the lawns just now. Okay, finally, there are some common errors that being made in preparing performance report based on budget and actual result. Okay, so the first one is by assuming that all costs are fixed, or the second one is by assuming that all costs are variable. Okay, so as you can see here, when we don't take into consideration of variable costs, the um, the performance review could be unfair. All right, so the variance could give us an unrealistic performance, by because wages and salaries, gasoline and supplies shouldn't be a fixed cost, because the more the more lawns that we mow, then these the more expenses will be incurred. Okay, for example, by paying the salaries of the employee, the gasoline and supplies, and then the maintenance of our equipment. Okay, so the higher the activity, therefore the higher the cost as well. But for the utilities, rent, depreciation and insurance can be considered as fixed, because no matter how much you are mowing the lawn, but you are still paying the shop rent, the office rent, and the insurance and so on. Okay, and then the second one is by assuming that all budgets are variable. Similar, utilities, rent, depreciation, and insurance will not be changed. Okay, it's going to be it is going to be fixed in some sort of way. Okay, it doesn't go higher when we mow our lawns. Uh, if we lawns, if we mow lawns, if we more lawns. Okay. Alright, so that's all for this chapter. Don't forget to attempt your tutorial. So for the exam, for the final task, you for this chapter, I will be asking you more to calculate on the variances. Okay, so please understand how to calculate the variance. What is activity variance? What is revenue and spending variance? And how do we get favorable and unfavorable variance for different items here? For example, revenue, expenses, and income. Okay, thank you very much.